Uber Technologies Inc., ticker symbol Uber, is currently trading at $60.76 a share. It's down about 13.5% over the last month. And is this the right time to buy the stock? We're going to be looking at the company's financials using my automated stock valuation spreadsheet, then seeing if it is a buy or sell using the discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. So if we have a look at the stock over the last year, it is down about 2%. And if we go on the 5-year chart, it is actually up about 96%. Lows of 27, had its all-time high at around about $87 a share and has dropped off to $60. So if we have a look at my spreadsheet here and put in the ticker Uber, this will load all the latest company financial data, and we can have a look at this. If you're interested, please check out my Patreon. I'll talk about more about that later. So $60 a share, 126 billion in market cap, a PE of 29.34, which is interestingly actually lower than the S&P 500 average. Earnings per share, $2.04, and a beta of 1.33, meaning it is more volatile than the S&P 500. Target price, analysts do say it is a buy, $90 a share, so that is trading at quite a discount. So here we have all of the latest numbers. Let's firstly look at revenue. Revenue is at all-time highs, just shy of 42 billion. Every year apart from 2020, where a little certain something happened during that year, they have increased revenue every single year, and then this year is no different, 42 billion. Net income, what are they doing with that revenue? Are they increasing profit? And yes, they are. It was negative 2019, 2020, 21, 22. They were able to become profitable for the first time in 2023, and now they have 4.4 billion in profit in the trailing 12 months. So that is excellent to see. Free cash flow, similar story as well, 5.2 billion in free cash flow. Once again, they were negative, finally broke a year earlier with a positive 390 million in 2022, 3.36 billion and 5.2 in the trailing 12 months. So that is good to see. In terms of operating cash flow, which is the blue, CapEx in the red, and then the free cash flow in the green, you can see operating cash flow is increasing as well. Switch from negative to positive and is increasing over the time. And interestingly, CapEx is decreasing slightly. So interesting to see. Shares outstanding, what are they doing? Well, they're issuing more shares. Obviously, this company is relatively new. This is quite common. Hopefully they're using this to invest more capital in the company, because obviously they're issuing shares. If we look at the share price over the last 5 years, kind of up and down all over the place. Realistically, if they've been issuing shares recently, that's when it's been its highest. But, you know, they can't control the share price. They can only hope it goes up. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. So looking at averages across this, you can see it's all over the place, minus $206 a share. So obviously that is not looking good. Now let's have a look at the numbers and see if we agree with them and what we want to change. So revenue estimates, we're actually expecting 21% growth, 51 and 68 billion in the coming years. Let's see what analysts are saying. Analysts are expecting in the current year 24, 43 billion and 50 billion in the next 2025. And also they're expecting around about big growth, 12% in the, 50% in the current year, 12% in the next year. So that was 43 and 50 billion. So yeah, 50 billion. I think we'll be a little bit more reserved there. We'll 150% we wish. We'll take it down to 14. The reason why this is obviously so messed up at the minute is because of these net income margins. So what we'll do is we'll initially take an average of these 2 years, put it about 7.7%. $81, but free cash flow here, this is the most interesting one. They've only had, in terms of free cash flow and net income, we'll take the trailing 12 months, 117%. Puts it currently at $43 a share. Now, if they were able to keep those margins at about 10.5%, that would put it at $58 a share, which puts it about fairly valued. And yeah, obviously weighted average cost of capital is quite high, but discounted free cash flow puts it at about fairly valued, which is quite interesting because normally discounted free cash flow models don't like these sort of faster growing tech stocks. Free cash flow ratio currently is around about 24. So quite interesting, it is fairly valued. Next, we'll look at the Ben Graham formula for intrinsic value. This was created by the godfather of value investing himself, Ben Graham. Earnings per share, P of a non-growth company, AAA bond yield, corporate bond yield. AAA bond yield is currently 5.14%, so quite high. And I think we saw the expected growth rate of Uber is around about 12%. So with the more, yeah, I don't think it's going to like this at all. 50% in the current year, 12 in the next. So at 12%, $30. But at that 50, it's 100. So yeah, it needs to be growing at about 27% for it to be fairly valued. But I like to look at the comparable company model. This is a way of valuing companies, looking at similar companies, and then we look at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, Peter Lynch's price to earnings growth, and then the metrics that go directly in the model are EV to revenue, EV to EBITDA, and PE. So companies that I do think are similar, and what we do is we put the ticker in here and it'll load all the latest company financials. So Lyft, obviously, that is one of their most direct competitors, ride hailing. Next is DoorDash, which is one of the leaders in the food delivery market, very similar to Uber Eats. And Airbnb as well. I think they are quite similar. I mean, it's a shared economy space and, you know, sort of a app where that is... There we go. Oh, it's loading the data. There we go. Yeah. So yeah, Airbnb I think are quite similar. Obviously not a direct comparison, but you know, people would say that Uber is to ride sharing, that Airbnb is to hosting. So what we'll do here: enterprise value, Uber is the biggest. Revenue, Uber massively, even 42 billion, obviously twice the size as everything else. 5-year growth rate. All these companies are very new. They don't have a 5-year growth rate. EBITDA, Uber is the highest. 3.4. Net income most profitable. Second highest profit margins. Airbnb is 17%, which is very high. Well, very high relatively. Lyft and DoorDash still in their early enough phases where they have negative profit margins. Price to sales, current market average is around about 3.6. So Uber is lower than that. DoorDash and Airbnb. Let me just quickly change this because I want to compare to directly to Airbnb at the end. So I'll just put Airbnb here. And then we'll do Lyft there. Lyft. Can't spell. So yeah, price to sales, second lowest. Price to book, lowest actually in PEG, which is Peter Lynch's price to earnings growth. Ideally, that wants to be under 1, and Uber is 0.85. So that is excellent. DoorDash doesn't have one, unfortunately. So EV to revenue, second lowest. EV to EBITDA, second lowest. PE, only one of the profitable ones and way lower than Airbnb's. And forward PE, second lowest. Lyft is actually estimated forward PE at about 17. So we don't have all the metrics here, but in terms of EV to revenue, $80 a share, and EV to EBITDA, 125. So an average of that would be $103 a share. So undervalued in that case. Now, if we were just to compare Airbnb directly, because I do think they are the closest, because it's, well, the only one we can look at metrics. $70 a share, higher on the EV to revenue, EV to EBITDA, undervalued, but P as well, 78, which puts it $69 a share. So discounted free cash flow model thinks it's about fairly valued. Ben Graham formula for intrinsic value doesn't really like it, but comparable company value, comparable company model does say it is a buy. Right, guys, thanks for watching. Check out my Patreon if you're interested in the sheet. Like and subscribe if you haven't already, and I'll catch you guys next time.